Good day, you're watching Business World Live. I'm Danie, Laurel.
And I'm Delos Santos. Here are today's biggest stories. Inflation likely quickened to its fastest pace in more than 3 years in June.
The Bangko Sentral says business sentiment for the next 12 months has worsened, with surging oil and food prices dampening the outlook.
Malacanang clarifies that President Ferdinand Marcos Jr.'s veto of the Bulacan Airport City Special Economic Zone was just meant to cure the defects found in the proposed measure.
And after slumping to a fresh multi-year low on Friday, the peso is seen to rebound this week. We begin our broadcast with Economist forecasting inflation to have accelerated to about 6% in the month of June.
This is on the back of surging oil and food prices as well as higher power rates. A Businessworld poll of 16 economists for last month's CPI yielded a median estimate of 6%. It realized this would be the quickest inflation rate since November 2018 and would also be faster than the 5.4% reading in May. It would also breach the Bangko Sentral's 2 to 4% target for 2022. Economists say higher inflation for June remains to be driven by persistently elevated oil prices, which are now impacting more commodities. Crude oil prices have been soaring over supply concerns since Russia invaded Ukraine back in February. Inflation data for June will be released tomorrow. Now, an economist sees the peso rebounding versus the dollar this week on bets of more aggressive tightening by the central bank. Union Bank Chief Economist Carlo Asuncion said a more aggressive hike is expected at the BSP meeting next month, as headline inflation is likely to hit an over 3-year high in June. This move is seen to provide support for the peso. The peso closed at 55.09 per dollar on Friday, losing 11.5 centavos from its finish on Thursday. RCBC Chief Economist Ricafort attributes this decline to recession concerns caused by the Fed's hawkish stance. Now, our guest this morning is penciling in a 6% inflation for the month of June. Should this be realized, does this make a stronger case for the BSP to hike more aggressively? Mike Ricafort, Chief Economist of RCBC, joins us via Zoom. Good morning, Mike. Thank you for joining us.
Hi, good morning, Jess and Danie. Thank you for having me.
Again, you see inflation hitting 6% for the month of June. Is this already the peak, or is the worst yet to come?
Well, we have yet to see the peak. Actually, it would be, well, at least now, it's not a one-way bet in the sense that we have seen already the risk of recession being priced in by the markets in terms of some downward correction in global commodity. For instance, wheat prices are down to pre-war, meaning before the Russia-Ukraine conflict. They're already at the lowest wheat prices, meaning that's the, well, even indirectly flour. That's already the lowest since February. Same goes with global rice prices. They have gone down already to the lowest in 2.5 months or since April 20. And among other commodities, we have seen even metals like copper, the lowest in more than a year. So even oil, global oil prices already corrected lower, the lowest in about 1.5 months. So there would be some upsetting factors for inflation. We may see the peak somewhere between June to October, but it could be a little over 6%. It won't go far from that because, on local factors, there may still be some lag effects. For instance, the adjustment in local fuel pump prices take about maybe around 2 weeks or so delayed vis-a-vis the global markets, as we have seen some correction. That's why we're already seeing some rollback. But we have seen that for more than 2 weeks already in the world market. So, at least, we have to balance things out. First, we have the higher wages, at least 6% increase in Metro Manila and in other regions. So that was effective a month ago in early June. So we saw already some upward price adjustments by a lot of companies. There may be some that haven't really raised their prices yet. Then we have seen also the upward adjustment in transport fares, the provisional approval. Um, so effective late last week, that's 2 pesos from 9 pesos to 11 pesos per. That's practically 22% increase in the minimum fares, and and given those two factors, higher wages, higher transport fares, there may still be some second round inflation effects, as of course the pass on being made by local businesses and producers. But of course, that would be mitigated by either competition or, and of course, softer demand as the country is still reeling from.
Sir, on the back of what you just mentioned po, softer demand, is that something that you are anticipating even as the economy has started to rebound? And if so, how would that affect inflation? Is there any demand-driven inflation effect that you're already seeing, or are you seeing that not to really have an impact as prices go high and consumers stop spending?
True, Danie. Where the economy is reopened towards greater normalcy, practically no more restrictions. With alert level 1 for Metro Manila and more than 80% of localities in the country. And that has been ongoing, at least for Metro Manila, since March. That's or more than 4 months already. So, yeah, there may be some pickup in economic activities, business transactions, but definitely, inflation has been largely supply side driven. So the supply side factors, these are external or exogenous factors beyond the country's reasonable control, such as the global commodity prices such as oil. So and fuel, as reflected on the fuel pump prices of gasoline, diesel, everybody's feeling right now. So it's largely because of that. The only thing that needs managing, of course, is the second round inflation effects that justify local policy rate hikes. Well, at least we already saw, we already heard signals last week of bigger hike of 50 basis points if necessary, and if it's supported by economic data, and of course partly to also support the exchange rate.
Now, Sir Mike, more to the point that you mentioned earlier, like what you mentioned, we already saw, of course, wage and fare hikes here, but what other second round effects should we be looking out for?
Well, of course, many other products and services in the economy. Some of them coincided with the increase in wages, and that's one of their justifications. Of course, they need to pass on, maybe for a lot of businesses and industries, because it's something that's beyond the reasonable control of the country. But somewhat they need to pass on to the consumers or the buyers. But of course, that is limited by competition, because other competitors may opt not to, because some of them may be more efficient. Some of them may have hedged their supplies better and secured their supplies better at much lower cost. So they could take advantage of that to get market share. But if you look at the whole picture, so given the wide-scale effect of higher global commodity prices to many countries, many businesses, so that's gonna, the pass-on cost would still be there, but definitely higher prices would lead to some demand destruction. Well, of course, which are the hard-hit sectors or industries by these high prices of energy. You see how the increase, the sharp increase in transport-related businesses. Of course,
Sir, should the central bank raise its rates by 75 basis points in the next meeting?
Well, so at least the signaling, the guidance that we got from the local central bank and the reiterations, of course, the preferred view is a gradual quarter point hike. And of course, they could escalate it by a 50 basis point hike, as mentioned earlier. So that's vis-a-vis expectations of another large Fed rate hike. So far, the consensus has been, the signals have been clear already from most Fed officials. Another 50 to 75 basis points hike by the Fed in the next meeting this month. So, that's another consideration on top of Well, of course, the need to raise rates locally to better manage both actual inflation and inflation expectations. But realistically, we have seen much higher inflation in the U.S. at 8.6%. They're already the same with the Eurozone. While the other developed countries, their inflation is much higher than ours. So, well, that and of course we will be again seeing the latest US CPI data on July 13th. And if there would the last time that we had for the data for May, it was a new 40-year high of 8.6%. That's the highest since December 1981. If there won't be any improvement to that, expect more aggressive Fed rate hikes to come, as they have already consistently signaled. And that has indirectly favored the dollar in terms of higher interest rates, so short-term interest rates by the Fed, creating this interest differentials in favor of the dollar versus global currency. So it's not just, it's a global thing. Ever since the Fed started signaling that they're going to normalize or hike rates, that was June of last year, more than a year ago, the dollar started to go up because everybody else, especially in the developed world, they came from zero or even negative. So it's more pronounced.
Okay.
Whenever they're
So of course, that's something we have to be keeping an eye on as to how the Fed will move. But so far here, at least domestically, another non-monetary intervention that government is looking into. You have the budget department going to roll out a first tranche of dolouts for the poorest of the poor. That's 6.2 billion pesos for 6 million beneficiaries. Is this going to be enough, sir? And is this something that we should at least be looking at as a staple form of assistance in the near term at least?
Yeah, true, Jess. This is part of the non-monetary measures, since these are brought about by external risk factors as far as inflation is concerned. So yes, it's somewhat targeted, to make it more efficient in terms of given the scarce resources of the government, the limited funds. We have seen already the country's debt rising to near record high levels lately. So, it just eased month on month as of the month of May, because of the repayment of debt. But of course, that remains, those are one of the urgent concerns that need to be addressed by incoming administration. So, number one is inflation, second to that is debt. And a way to mitigate the risk of inflation is through these subsidies, especially on the hardest hit sectors. We have seen that beforehand already on the transport sector, the agricultural sector, and now with the poorest of the poor. Also to partly manage, but to also ensure that there won't be any pickup on the poverty rate on the hardest hit sectors. So that's one way. And at the very least also, to prevent the pass-on costs to the general public. So that's one way to do it right now as part of the non-monetary measures, which are, as long as they're targeted, they're more efficient, there won't be any risk of leakages or wastage. So, that's one of the best ways to approach.
Mabuting
But of
ayuda.
course, it's a delicate balancing act.
Sir, before we let you go, just a question on the peso. You have your own forecast here. Of course, it's very difficult to forecast, but you did mention it might be hitting 55.25 to the greenback. The question is, sir, what is a level that you are comfortable with, and where do you see this going? Are there risks to the upside or the downside, particularly as you're expecting inflation to hit 6%?
Yeah, true, Danie. It's kind of difficult to really assess carefully given the volatility, the risk of, we've seen especially external factors. It's a function of how aggressive the Fed would be in raising rates. So that has caused and favored the dollar since last year and early this year. So, but if you look at it very well, it's kind of overdone already, in the sense that we came from 51 the end of last year, so it has gone up by more than 4 pesos. So also the BSP has already came up with signals by saying they're ready to smoothen the volatility and intervene, and at the same time they're ready to raise rates by a bigger 50 basis points. So those are the appropriate response to really address this. So they're there. So it's like saying to the markets that they're ready to burn the speculators.
Okay.
So
Good to
yeah, so
know.
that's one way. And it's relevant to the region, of course. It's all kind of overdone already.
All right. So overdone and hoping for some peso strength there as the BSP steps in to act and support the local unit. Thank you so much, RCBC Head of Economic Research. That was Mike Ricafort.
Thank you so much.
Now, pausing for a quick break, but coming right up after that. Bulacan Governor Daniel Fernando throws his weight behind the veto of the bill seeking to create an airport ecozone in the province.
More of that and other stories when Business World Live returns. Stay with us.
And you're still watching Business World Live here on One News. I'm Jess Delos Santos.
And I'm Danie, Laurel. Now, President Ferdinand Marcos Jr. has vetoed the bill seeking to create the Bulacan Airport City Special Economic Zone.
But Bulacan Governor Daniel Fernando agreed with Marcos Jr.'s decision, saying the proposal needs to be reviewed first. Camille Samonte with the details.
On his first day in office, President Marcos vetoed House Bill 7575, which seeks to create a special economic zone and free port in Bulacan Airport City. Marcos Jr. said the proposal is short, significantly higher the tax base, and is mandated in sectors applicable to registered enterprises. The government would be forced to seek new sources of revenue through additional taxes or borrowings in the future, with taxpayers bearing the brunt of the burden. The economic zone covers San Miguel Corporation's New Manila International Airport, which can serve up to 100 million passengers per year. Bulacan Governor Daniel Fernando agreed with the president's decision. Fernando said the special Ecozone must be reviewed first since the government needs to produce revenues after 2 years of COVID-19 lockdown.
Kailangan pa rin naman reviewing yan at kailangan mabusisi natin kasi hindi naman dumaan yan sa public hearing. Hindi yan na-konsulta ang provincial government. Kailangan muna natin ay magkaroon ng revenues ng kita ang ating gobyerno. At sa mga darating na panahon, saka natin tingnan at pag-aralan yan.
Fernando likewise pointed out that he is not concerned about the impact it will have on the province. Meanwhile, President Sister Senator Amy Marcos, who sponsored House Bill 7575 in the Senate, expressed disappointment over the vetoed measure. She said the project would have provided jobs in Bulacan and nearby areas, but added that she understands the move. San Miguel Corporation, meanwhile, has yet to release a statement on the matter. For News 5, Camille Samonte, we are One News.
Meanwhile, Press Secretary Trixie Cruz Angeles clarifies that President Marcos fully supports the creation of the Bulacan Airport City Special Economic Zone. In a statement, Cruz Angeles explained that Marcos Jr. only vetoed House Bill 75075 to, quote, cure the defects in the measure. This includes the provision that prevents Commission on Audit to look into the financial transactions of the Special Economic Zone. Malacanang also clarified the construction of the 740 billion peso Bulacan International Airport is not affected by the veto. Had the president not vetoed the bill, it would have lapsed into law today. Business sentiment worsened for the next 12 months, with consumers less likely to spend amid rising oil and food prices. The Bangko Central's latest business expectation survey showed that the second quarter confidence index fell to about 60% from nearly 70% in the previous quarter. The report attributes the less positive outlook to uncertainties brought about by the new administration, seasonal decline in production during rainy season, and higher inflation expectations. That's on top of vaccination target concerns, China lockdowns, and possible stagflation due to the Ukraine-Russia conflict.
Now, fuel prices are expected to go down in the coming days. That's following back-to-back increases over the past weeks. Now, Unioil sees diesel prices going down by close to 3 pesos a liter, while gasoline prices could see a 10 centavo per liter rollback. Now, Energy Department Oil Industry Management Bureau attributes the potential rollback to the lockdown in China and the interest rate hike implemented by the U.S. However, Abad stressed that the decline in fuel prices might not be sustained as the lockdown in China is set to be lifted, while the effect of the interest hike in the U.S. could eventually subside.
Unang-una, yung lockdown sa China, no, sa Shanghai. At the same time, nasundan kaagad yan nung interest hike announcement ng implementation ng US. At sumusunod na rin po ang iba't ibang bansa, including yung Philippines. Earlier this month, nag-announce na ang Pilipinas ng pagtaas ng interest rate.
And those are the biggest stories on the economic and corporate front today. I'm Jess Delos Santos.
And I'm Danie, Laurel. We are One News, and we will give you the latest on the local bourse when Business World Live returns, so stay with us.